Essential purpose bonds are issued by municipalities for essential traditional public purposes. Essential purpose general obligation bonds are secured by the full faith and credit and taxing power of the issuing municipality. These bonds are usually issued for the construction of schools, jails, courthouses, or other public projects. Alternatively, essential purpose revenue bonds are backed by a revenue pledge of an established enterprise fund issued for the construction of improvements to an existing water, sewer, or electric system that already has a history of payment. Such bonds are secured by the revenues from services that are critical to a geographic area and are either natural monopolies or have strong protection against competition. Non-essential purpose bonds are issued for purposes such as housing, healthcare, waste-to-energy, private universities, etc., or assessment bonds issued for land development or other property improvements. Many non-essential purpose bonds are conduit bonds issued by a municipality without a municipal tax or revenue pledge and are sold on behalf of a non-governmental obligor. History demonstrates that essential purpose bonds are generally higher quality and less speculative than non-essential purpose bonds. In March 2012, Moody's Investors Service, one of the oldest and largest municipal bond rating agencies, released a report entitled U.S. Municipal Bond Defaults and Recoveries 1970 through 2011. While past performance is not indicative of future results, Moody's reported that there have been 71 defaults involving Moody's-rated municipal issuers between 1970 and 2011. Moody's found that the average 10-year historical cumulative default rate for investment grade, AAA, AA, or single A categories, municipal debt was 0.08%, while the same cumulative default rate for below investment grade debt, not including non-rated debt, was 7.94%. The Moody's report identified that during the 41-year study period, only 5 general obligation bond issuers, 7% of defaults, including cities, counties, and other districts, defaulted on general obligation bonds. The Moody's report also determined that only 1 general obligation issuer out of approximately 9,700 rated by Moody's at the end of 2011 defaulted on general obligation bonds in the last 3 years. Additionally, throughout the study period, 73% or 52 of the 71 defaults occurred in the healthcare and housing sectors within the non-essential purpose category. In March 2011, Fitch Ratings, an independent source to the Moody's report, published a research report entitled Fitch Ratings U.S. Public Finance 2010 Transition and Default Study. The Fitch study universe consisted of all municipal bond defaults within a pool of more than 22,000 Fitch-rated U.S. public finance debt issues from 1999 through 2010. In their research report, Fitch identified 11 defaults on Fitch-rated U.S. public finance debt issues over the period from 1999 through 2010, resulting in an average annual default rate of 0.04%. Of the 11 defaults referenced in the Fitch report, 9 carried non-investment grade ratings. In addition, it was noted that 10 of the 11 defaults were in the healthcare or housing sectors within the non-essential category. History shows, based on these studies, that in the face of negative press and worrisome headlines, if an investor focuses on a diversified mix of higher quality, investment grade or better, essential purpose bonds, and if those bonds are held to maturity, an investor may better protect against loss of principal while generating reliable tax-exempt income. Essential purpose municipal bonds, along with other fixed income investments, may be purchased through Zions Direct at 1-800-524-8875 or zionsdirect.com.